Good evening, Rand Swiss. I hope that all is fit and well. It is 6:30 Cape Town time. I've had a very, very hectic day. As I said to Pascal and Gary, I was at the National Agricultural Fair in Bredasdorp, which is a 3-hour drive one way from Cape Town, actually presenting with the Western Cape Premier, Alan Wind, on the underlying agricultural economy and the impacts of the Russian-Ukraine crisis and the potential loss of AGOA because of the diplomatic spat that this country has had with the United States regarding the Lady R, amongst other things. So if I suddenly take my glasses off and suddenly do this to keep my eyes open, it's because I was up at 5 a.m. I've driven 7 hours today, and I've already done quite a material media interview on the agricultural side, which has gone national. Firstly, a great thank you to Rand Swiss, as always, for organizing this quarterly session. It's become a regular event, and hopefully it's of value to those that dial in. We have decided to move it to 6:30 in the evening, purely to try and accommodate those who I know have to battle through the traffic to get home to switch on their PCs, and I'm hoping it's a more elegant time. If you'd like a more suitable time, or perhaps have any suggestions, just drop Rand Swiss a message, and I'm sure we will accommodate future presentations for the next quarter. The chat box is open. I'm looking at it here, but as you all know from now, I'm not that technologically advanced. So I'm hoping that questions will come through. So we'll save that towards the end. I intend to ramble through my usual roundup of the small to mid-cap markets. Some of the features in reporting season, which has really caught my eye in the last couple of weeks. Run through some stocks, which I think look quite interesting, and some updates on those I've discussed in the past. And then towards the end, probably in about 50 minutes time, open up to Q&A. I've got my soft drink here, so if you see me reaching for it every now and again, it's not brandy and Coke, given I've been at a farmers convention, but I think after today, it should be. So I'm going to kick off. I'm currently coming towards the end of the current reporting season. As my little diary here says to me, I've seen, as of today, 36 separate corporates in the last 15 working days. And I'll probably have another dozen to see until the reporting season finishes next week. So anyone who looks at my office, and I showed Pascal a picture earlier, and I'll do it again right now, you can see the pile of papers that I have there. That's reporting season, literally from the last 2 or 3 weeks, which I'm still plowing through. So as my institutional clients know, whenever I'm very quiet and there isn't much written content, it's because I'm running around actually seeing companies, getting direct first-hand information from the companies, and the proverbial kicking the tires, which I know some of you online tease me about me kicking the tire, but it's an old English saying. So looking at the market year to date, I always benchmark myself against the key indices, and the all-share market, as it closed tonight, is up 0.4% year to date. So it's basically flat. The small cap index is down 1.3, and the mid cap index is down 5.3, showing the material underperformance in the mid cap index relative to the small cap, relative to the Aussie. Now, why has that been? There has been a bit of a sell-off in the small to mid-cap market, particularly in the last quarter. That was predicated when South Africa was put on a grey list, when we basically missed implementation of international money laundering regulation. And as such, the risk parameters of this country fundamentally changed. And many international funds and organizations basically told their investors to get out of this market. And what also happened at the same time is that the prudential limits allowing domestic funds to invest offshore also changed. You all know that under Reg 28, a significant proportion of money, I think it's 40 or 45% of your money, can now be invested offshore. It used to be about 25% from memory. And as such, there was a rush of money out of this country to take advantage of that prudential limit change, particularly in a period of very weak rand devaluation against the dollar, the euro, and the British pound. Now, in the domestic marketplace that I cover, it was very difficult to try and top slice any material holdings in the small cap sector purely because of their size and, more importantly, their illiquidity. So if you're a major institution looking to take some money off the domestic landscape, which is where the small to mid-cap stocks tend to sit on the JSE, the easiest port of call was to start selling your mid-cap shares, which at a slightly bigger market valuation, call it between 3 to 10 or 11 billion rand, and where liquidity tends to be a little bit greater. So that has seen quite a bit of toing and froing regarding the selling of certain stocks by institutions, but for every seller, there has to be a buyer. So as an example, the PIC have been quite aggressive sellers of the mid-cap index in the last few months. And they've been quite open in the fact that they're taking that money offshore. Now, I always find it quite surprising that the government pension fund, which will be here supporting domestic industry, domestic workers and domestic investment, is happily selling the local market in small to mid caps, take the money offshore. But they have their own mandates. But that's been one of the reasons, amongst many other institutions, top slicing their mid caps, but have seen weakness in the mid cap sector. But saying that, there have been pockets of strength that have popped up in the last few months, in particular the last 6 weeks. I'm turning my page here as I look at my notes, and I'll take another little sippy. I was asked by a client last week, of all the companies that I've seen to date, which ones have stood out in my mind as having results, commentary, optics, or narrative, which is above and beyond expectation? And my answer was very simple. Firstly, the private education sector, which is Curro, Advatec, and Stadio, have had a fantastic run since the early part of June. The other stock which really interested me was Bola Metcalf, which I met last Friday, where the German CEO, whose family are the largest shareholder, is not known for his exuberance and his sparkle. And he was positively gushing at the underlying prospects for the small packaging company in the domestic marketplace. And I'll elaborate on that later. And then the other stock that really looked interesting to me was Omnia, who I bumped into today at the Agricultural Fair in the Western Cape, and Afrimat. I've also had a very interesting meeting with a newly listed company on the JSE, but it's actually been around in varying incarnations for the best part of nearly 30 years. That is an FMCG, which is called a fast-moving consumer goods company called CA and Sales, whose JSE ticker is CAA. So I'm actually going to start with the education sector. Just for a little bit of a tidbit, as I turn around here, many of you know that I actually write as a sideline for the Financial Mail magazine. It gives me good exposure and basically free marketing, because as an independent analyst, without having the large pockets of my major banking and international stockbroking competitors, I simply can't afford to spend the money that they do on marketing and such. So I basically write for the Financial Mail, and it gives me a very good presence. And here's a piece that I've just written as a special feature on the education sector, which will be in the end of month Financial Mail out the last Wednesday of the month. So keep an eye out for that on Stadio, Curro, and Advatec. But I'm going to run through the reasons right now why they've outperformed the general market, why I think they're going to continue to perform, and what has been the reason why these stocks, in many cases, are up between 30 and 40% since the beginning of June, which is materially better than the underlying markets they participate in, and of course, the underlying indices they are domiciled in. So it all starts with the annual general meeting season. As many of you know out there, I'm a huge fan of going to annual general meetings. They're either online or in physical events where you can basically rock up and just sit there and listen and question the board. You don't necessarily have to be a shareholder. You can politely go in, sign in as a visitor, and they more often than not allow you to ask questions. As an analyst of record in this market now for the best part of 27 years, I attend lots of AGMs, and the value I gain from them are immeasurable. That's the tidbit that I picked up regarding the education sector. From the early part of June, Curro, Advotech, and Stadio all had their AGMs. Now, AGMs, by their very nature, are quite technical and regulatory in their function. You just vote on varying resolutions, and it's all very boring. But saying that, you generally have a period after the legal resolutions to ask questions. And in many cases, the CEOs of the companies actually give updates, which generally only go out to the AGM, but are often published online. But most people don't pick them up because AGMs are not exactly, that common an event for investors to actually bother to listen to. But I do. And the reason I do is because you generally get absolute pearls of information coming from AGMs. That's what happened in the education sector. Curro, Stadio, and Advotech told the very limited assembled audience, and in many cases, I'm only the only sell-side analyst that participates. And I think the biggest AGM that I went to probably had maybe 5 or 10 people at it, if you exclude management and the hangers-on. So you often get information way ahead of the market and often timed ahead of the next interim or final results. So in the education sector space, Advotech, Curro, and Stadio all had AGMs just before their June interim reporting periods. So listening into those AGMs and reading the presentations and questioning management actually got you the juicy insight as to the indication and the narrative that will be coming from management for results. It was very clear to me from the CEOs of those 3 education companies that they were all doing significantly better than the market anticipation for growth and for earnings. 2, they were all containing costs quite nicely. 3, they all saw organic growth in their underlying learners. 4, they were passing on above average fee increases to the parents. And 5, the ongoing failure of a state education system in schooling, and particularly in the tertiary side. Many of you may have read that UNISA, the once mighty university there in Pretoria, has basically been the latest government entity to fall in a heap. And as such, 370,000 learners are currently floundering regarding their education. Now, that leads to opportunities for those individuals, particularly in the private education space, that offer private schooling, or in many cases, private tertiary operations. So as the state fails, as it has done in many industries in the last 20 or 30 years, we've got private security, private education, private healthcare, etc., etc. The private sector picks up where the state basically falls away. And that's exactly what's been happening in the schooling side. As more and more parents realize, particularly in primary, but more importantly in the matric segment of secondary schooling, that their children's education is the benchmark as to them either getting into a university of their choice or getting a university place and potentially, getting a job at the end of their education period, particularly in an economy like ours, where finding employment is increasingly difficult. So having a very good education behind you at least gives you a starting point ahead of the masses. And that's meant there's been very good organic growth in the education sector in the last 6 months, between 3 and 5%. Now, that may not sound like a great deal, but it's all about operational leverage. As Dr. Chris van der Merwe, who founded Curro Holdings many years, told me, he said, Anthony, it's often the last child's bum in a seat in a class that makes all the money. Because once you've built the school and you've hired the teacher and you've got the hockey fields, the soccer fields, the halls, the swimming pool, etc., you need to start filling up that school to actually optimize the capital that you've spent. As the schools start filling up, you start reaching what's called the J-curved effect, where the number of learners coming in actually benefits the company, because whether you have 15 learners in a class or 20, the same teacher is there. The extra 5 learners are basically the extra profit the company is making. And in all the company's cases, they're starting to see significant leverage benefits, particularly in Curro, which is one of the newest education entities out there in schooling, which has spent to date 12 billion rand, putting down over 200 national schools. And as these schools start to fill up, you get what's called the J-curve effect. Now, for many years, Curro let the market down by actually missing the earnings profile, constantly raising rights issues to fund the ongoing expansion program. And the last rights issue they had in August 2020 at 8 Rand and 7 cents raised 1.5 billion Rand. There was only 85% subscribed by the market. PSG, as the underwriter, was left with 15%. So that rights issue, quite frankly, did not go well. So the weak rights issue back in August 2020, alongside the effects of COVID on the education sector, then we had the ongoing unbundling of Curro and Stadio from PSG in 2022, meant that Curro in particular saw massive overhang and weakness in its underlying model. In the last 12 months, that has fundamentally changed. And results to the year of December were very strong, with earnings of 61 cents a share. And the recent interim results were up 21% to about 36 cents a share. So on a price earnings basis, Curro is probably trading on a P of around 16. I checked today before I came online. The share price is currently 10 Rand 40, year to date up 12.4%, and has just hit a new 52-week high. Now, my favorite in the education sector, as my Financial Mail article will have indicated when you read it, has been Stadio since 2020. I first recommended the stock back in April 2020 at about 1 Rand 16, and again in 2022 at 3 Rand 56 from memory. It's currently trading at 5 Rand and 7 cents, so it's had an exceptionally good gain. Now, the reason I like Stadio as an education company, and if I had to only be in one educational stock in the longer term for any portfolio, given the inherent growth I see in the domestic marketplace for private education, I would want to be in Stadio for a couple of very simple reasons. One, it's mostly online. 86% of the near 42,000 learners actually do their education courses on our laptop, on our PC, in their own time. Now, what does that mean and why is it important? It means it needs less physical points of contact. They only have 2 major campuses in Gauteng, in Centurion and in Krugersdorp. They've got a couple here in the Western Cape, mainly in Bellville, and they're building a very large campus in Durbanville to cope with the expected demand as the 91 accredited qualifications they currently offer get expanded by a further 47 in the next 12 months, all of the professions: accounting, education, law, business science, information technology, etc., etc. So they are actually offering qualifications, enabling participants in most courses to hopefully find gainful and suitable employment. Stadio, as such, has operational leverage because as most of its classes are online, if you're streaming the class to 1 person or 1,000, the cost is basically the same. Yes, there's additional incremental cost in bandwidth and providing additional technology services and perhaps extracurricular feedback and tutorials to a wider online audience. But you physically do not have to build more schools or hire more teachers. You know, it's basically the soft angles that you need to provide more of. So Stadio starts moving towards a 2026 target of 56,000 learners and 500 million Rand in profit. They will start to generate significant amounts of cash. And given they are asset light, meaning they do not have to physically put down bricks and mortar schools or colleges, unlike the like of an Advotech, which has Varsity College, Rosebank College, and many others. They have that operational leverage, which means that 80% of Stadio's earnings from about 2026 will start being paid back to shareholders in the form of fat, juicy dividends. And I like that story. It's cash generative. It is self-funding. It'll never need a rights issue. It doesn't need to do any acquisitions. It just needs to get, its own qualifications accredited and then get people to sign up. And the real interesting element here, as I mentioned at the start of this preamble on education, is a failure of the state system. Now, many years ago, the Model C schools in Gauteng lost a very important High Court case, where the Minister of Education in Gauteng demanded that Model C schools, which charge quite a fat fee to parents to send their children there, actually start expanding the size of their classes to actually allow more students to participate in that quality state-owned education, which in many cases can be quite expensive. The Model C schools fought back saying, no, we are charging a fee to provide smaller classes and better education than you get in a wider state education system. But they lost the case. Now that means the normal small classes that the Model C schools enjoyed have now started to expand. So if you were a parent used to only having maybe 25 or 30 learners in the class, and you're now pushing 35, 40 or 50, you would assume that the quality of your child's education is being impinged. And you might wonder why you're paying 40, 50, 60, 70,000 rand a year for a Model C state school, when for the same money, you could send your child to an Advatech or a Kuro, which has much smaller classes, a very high level of education standards, and significantly better and more modern equipment, technology, and resources. And that's exactly what's been happening. The underlying growth in the secondary schooling market has come from Model C parents yanking their kids out of school and sending them to the nearby private education market. On the tertiary side, we all know the problems that the state universities have had with WITS, UCT, Fort Hare, etc., having student violence and all sorts of disruption during the exam period. Again, if you're a parent paying for your adolescent to go to one of these tertiary operations, and there were all sorts of shenanigans on the go with disruption, you might not be happy. And you'd say, you know what? I'd rather send my child to a private university or a private college where I know they're going to get a decent education and there isn't going to be this communist backlash from the underlying authorities regarding, the underlying running of that administration. UNISA, as we have all read in the financial press in the last few months, has basically buckled, and they've let their students down very badly with very poor service, all sorts of maladministration, and even talks of corruption. And that has fundamentally damaged, in many people's eyes, the status and the credibility of UNISA. So it's 370,000 learners. Not all are going to leave, because a significant proportion actually get a subsidy from the government to actually only study at UNISA. But those that actually can afford to actually move away will probably be looking at the likes of an Advatech and a Stadio for their tertiary education requirements. And I'll give you one statistic to wrap this segment up on private education. I asked Chris Forster, who's the CEO of Stadio, what his single biggest education course is. He goes, out of our 42,000 learners, we have 11,000 students studying some form of education qualification. And I was quite surprised at that number. And I said, why is it so high? He goes, Anthony, for one simple reason. If you've lost your job in this economy and you're using your skill sets to perhaps retrain yourself, a better course of action has become a teacher. Secondly, if you've left varsity and you want to upskill yourself, if you become a teacher in a chosen profession, you stand a much better chance of potentially enabling yourself to emigrate from this country because you have a qualification which is an international demand. And we all know the number of people, but we probably know friends of ours who have left this country to take up teaching jobs in the UK, Australia, New Zealand, Canada, and the like. And that's why in UNISA's case, of 370,000 learners, 130,000 are doing some form of education qualification. Yes, many will end up in the state system or a domestic education system, but many are surely doing that qualification for the potential to either try and upskill themselves to find a career or maybe emigrate in due course. Now, I mentioned that number, 11,000 at Stadio and 130,000 at UNISA studying education, showing you that if Stadio just picks up 10% of the learners at UNISA studying education, it can double its underlying business, showing you what operational leverage can do, particularly when the state falls aside. So as it stands right now, I've got Kuro at 10 Rand 40, Stadio at 5 Rand and 7 cents, and Advatec trading at around 21 Rand and 40 cents. They've all had really excellent performances this year, substantially outperforming the JSE All Share, the small cap index, and the mid cap index. And in many cases, since their AGMs in early June, the stocks are up between 30 and 40%, showing you that if you catch a stock when the market isn't expecting good news, there's very good money to be made. So I'm often questioned and criticized, Anthony, how is it as a lone individual analyst in the institutional market, can you actually make a difference when everybody seems to know everything and the information is flowing freely? The answer is most information is not flowing freely, because in the small to mid cap universe, you actually have to go out and find it. You've got to kick the tires, visit the companies, and consistently engage with management, because in many cases, the information is not as widely available or disseminated as, let's say, an Aussie 40 stock. And that's why, as I said, if you'd listen to the AGMs of these three companies, Advatec, Stadio, and Curro, your portfolios right now from June would have been up between 30 and 40% if you'd bought at that point. So that's my wrap on the education sector. In terms of ranking order, my number one buy is Stadio, my number two buy is Curro, and my number three buy is Advatec. Not that Advatec's a bad company, but I think there's more operational leverage and more upside potential in Stadio and in Curro over the next 12 to 24 months than in Advatec, which has already doubled in the last year and a half. I recommended Advatec as my play in, I think it was mid-2021 at 11 Rand 35. And as I said, right now it's trading at about 21 Rand 40, 21 Rand 45. Another little sippy. I've seen no questions coming through, so I hope, Pascal, the question thing is actually open and there's people actually online listening to me. The next stock I'm going to talk about is probably one of the most interesting meetings that I've had in the last couple of weeks. It's a company called CA and Sales. The mnemonic, as I said earlier, is CAA. I actually wrote about that stock in, let me just double check my columns here, in case I have written about it. Here we go. In the next edition of the Financial Mail will be a piece on CA and Sales. They're a June interim reporting period, and I actually had a meeting in Cape Town with Duncan Lewis, the CEO, about a fortnight ago. They had a very good interim results period, having had a sparkling year-end results to December 2022, when earnings came in at 78 cents. Now, the interim results from memory were up in the early 20%, and the price-earnings ratio of that company on historic numbers is around 10.5 times. So what is CA and A? CA and S? Oh, I'll just call it CAA because it's easier. What they do is they're a fast-moving consumer goods company. So they don't actually produce the goods. What they do, let's say that you're a major multinational like Nestle, Mondelez, Diageo, Suntory, Reckitt Benckiser, or any of the major international consumer good companies whose products that we buy on a daily basis. You can easily walk into a Pick and Pay, a Checkers, a ShopRite, a Usave, a Boxer, and buy the products in these countries. But many of these international companies know that the real fast-growing market is into Africa. We all know the population there is urbanizing. They're actually becoming slightly wealthier, and there's a trend to actually want to buy more consumer goods. So what CAA does is it takes these consumer goods on behalf of these major multinationals and even the domestic large companies like Tiger Brands into countries like Namibia, Eswatini, Lesotho, Mozambique, Zambia, Zimbabwe, and eventually Kenya, Tanzania, Rwanda, and Uganda. And they basically put those products, not just in the formal retail space in the major supermarkets in those countries, but the real growth area in the African hinterland is in the informal market and in the rural areas. Now, there has to be a certain degree of expertise to actually get those products, from point of origin to an informal trader in parts of Africa or into a formal retail network. It's not as easy as just dropping off a box and assuming it'll actually get to the underlying participant. In many cases, you have to break bulk because an individual trader operating in a small village in Zambia is not going to want 20,000 bags of chips. They just want a handful. CA&S has the expertise, the contacts, the logistics, the warehousing, the marketing, the distribution to actually get these consumer goods to where they're actually sold. They actually make a nice margin in the wholesaling and in the distribution. The real sweet spot of this company is in marketing. When you go to supermarkets in this country, you often see the end of aisle promotions where there's a special on at the end of the month. You buy one, get one free, or there's a special on a certain product or a special price, which captivates the consumer to potentially buy it. You often have in-store promotions where there's some gentleman or some lady offering you a sample of a product for you to try or take home. That's what CA&S does in African markets to try and persuade consumers to actually buy or participate in this product category, and they do it extremely successfully. Revenue in 2022 was 9.5 billion rand. Their targets for the next 5 years is to grow that organically and through selective acquisitions to 20 billion rand, which is a hell of a leap. Can they do it? The answer is yes, they can. Duncan Lewis was extremely confident last week that they will meet and exceed that target. And the key to this is actually broadening the marketing channel, where the underlying margins that they gain from marketing the product rather than just delivering it to store is often double the price of the logistics margin. So think about it logically. You've got a growing African population. You've got a growing bunch of consumers that want to participate in the consumer environment, and they also want, the international brands that we in this country take for granted. You've got international FMCG companies wanting to push their products into this growing African market, and CA&S is the glue in the middle that puts both of them together. So the single largest market for the company is Botswana, which is about half their sales. The fastest growing territory is Namibia, where they see significant runway going ahead. It may be a very large country with a small population, but as I've written recently, and as some of you may know, Namibia has basically struck black gold with massive oil deposits currently being explored off the coast of the country. And all being equal, in the next decade, Namibia is going to become a fantastically wealthy country, and the underlying consumer base in that economy is going to be uplifted to become one of the wealthiest in the African continent. No wonder everybody's looking to get into that region, and CA&S have been there for nearly 40 years. Also expanding into Zambia, given the change of government there has seen far more friendly capitalist policies towards consumerism. And of course, the former East African territories of Kenya, Tanzania, Uganda, Rwanda, also growing extremely fast, with a consumer base hungry for international brands. So CA&S for me is currently trading at 8 Rand and 60 cents. Year to date is up 32.3%. Now, I may sound enthusiastic about this company. One, I am. I own it myself. I have done for probably the best part of 2 years. It was a spin-off from PSG when PSG unbundled itself last year, and the company moved its listing from the Cape Town Stock Exchange to the Johannesburg Stock Exchange in June 2022. I had the first buy recommendation on the stock at about 5 Rand 34. It was June last year. It's also one of my top stocks of 2023. And I had a target price when I recommended this stock at the beginning of this year of 8 Rand 50. It made that price target 2 weeks ago. The share price in the last few days did fall back to 8 Rand 20, which I thought was an opportunity for those investors who had missed the easy money to get back in. And as I've written in my Financial Mail article, without giving too much away, my target price for CA&S 12 to 18 months out is 40% higher than the current level, with a target price of 11 Rand and 50 cents. Its current market value is about 3.9 billion Rand from memory. And I will say on public record on this forum, I expect CANS to be the next dual blue chip mid-cap stock in about 5 years' time. The reason why it's currently running is that institutions that did not understand the company upon its unbundling from PSG are suddenly cottoning on as to the benefits of having a company which has expertise operating in the consumer-facing environment in the greater African continent, because that's where the growth is. And that's why the stock is running. And I think as more people get to understand CANS and understand its growth profile, the underlying earnings should start to be delivered by the company, and as such translate into significantly better valuation and as such share price. So my second top pick in this presentation, Stardew being the first, is CANS, JSE code CAA. Another little sippy. When this drink is gone, I'm going to Q&A. I was at the Nampo Trade Fair today, and I bumped into Omnia. Now, Omnia, for those that follow, is an agricultural and explosives company, which has had a huge run in the share price when it basically had to have an emergency rights issue a few years ago to raise 2 billion rand at 20 rand to stop itself going, quite frankly, belly up. A new CEO was brought in who has dramatically transformed the fortunes, profitability, and operating performance of the company. And its near-term high was 80 rand. In the period, it's paid out 17 rand 75 in a combination of special and ordinary dividends in the last 2.5 years, which is a stellar payout for any company that I cover. However, the share price over the last 3 or 4 months has been weakening. Year to date, the stock is down 12.7% and is currently trading at 54 rand and 6 cents. There is a reason behind that. In the last agricultural season, which we've just passed, because of the Russian invasion of Ukraine and the sanctions were imposed on Russia and its neighboring territories, certain key raw materials that the Western markets rely on, like phosphates, ammonia, urea, that go into fertilizer, were basically precluded from entering the global supply chain. And there was a tightness in the availability of those raw materials and molecules that make the basic fertilizer that farmers need to grow our crops. The fertilizer price in 2022 went up, in many cases, over 100%. Companies like Omnia, which manufacture locally, made hay while sun shines. Domestically, we have had 4 excellent years of agricultural output because of the La Nina effect, wet summers and mild weather. The maize harvest this year is the second best on history at 16.4 million tons, and the soybean harvest is the biggest we've ever seen at 2.8 million tons. So they actually benefited, one, from international higher prices of soft commodities, and two, at one point, low fertilizer prices. However, last year, fertilizer prices were high, so the farmers were not making as much money. In the last few months, as the global supply chain situation has eased and natural gas prices, which is a main feedstock in the production of ammonia, have come back to more normalized levels, given that the European Union basically stopped buying gas from Russia, and international wholesale gas prices, which are made in the Dutch spot market, basically went up several 100%, cutting off the natural production of ammonia. That's all now normalized, and fertilizer prices globally have come down quite sharply. The market believes that there will be a significant fall in the underlying profitability of the fertilizer division inside Omnia, which last year contributed roughly 1 billion rand in profit to the company. Make no doubt, Omnia's agricultural interest this year will see a lower contribution than last year's bumper profits due to extraordinarily high fertilizer prices on the back of the Russian and Ukrainian crisis. They've now normalized. International prices of soft commodities remain elevated. We also have a weak rand, which means that exports of soft commodities also remaining quite high. We are about to enter the next planting season, which traditionally starts in this country in early October. The harvest season normally starts in about late May as the frosts start to hit the northern regions where most of the maize is grown in this country. Now, that's basic background. I'm anticipating this year that we'll see another very good harvest planted of commercial maize, less soya planted because of what's going to be happening with the weather patterns next year. I've mentioned we've had 4 good seasons because of La Nina, slightly wetter, milder conditions. Next year, we're going back to El Nino, hotter weather, lower rainfall, which means crops like soya, which are far more prone to dryness, may not be planted as much, and more maize may be planted because it's more drought resistant. Now, I'm giving you all of this granular feedback because if more maize is planted, maize uses 4 times the level of fertilizer than soya. So if farmers cut back on soya hectares and plant more hectares of maize, they need 4 times the amount of fertilizer. We are currently in a tight situation of fertilizer in this country. I mentioned earlier that if we're going into an El Nino next year, where it normally kicks in with a drier, hotter period, starting from February 2024, the farmers want to plant early. If the farmers plant early, which means they're looking for fertilizer right now, and anybody who has not imported fertilizer or has got fertilizer on the water may have missed the actual window where the farmer actually wants to buy the product to actually spread on the land to aid the growing of the seed which will be planted in October. So as I've heard from my agricultural friends and from Omnia today, there's currently a tight supply of fertilizer in the domestic marketplace ahead of the very important planting season, which is literally going to start in early October. That means that prices, which have fallen on average 30% year on year, will see lower profits from Omnia, but they may not be as bad as the market thinks because volumes may be higher because of the tightness in the market. And those that have supply actually then become the price makers. And Omnia currently has plenty of supply. So I think, given that Omnia's agriculture division may not do as badly as the market anticipates, and the other side of the business, which is called BME, involved in explosives in the mining industry, in this country, into Africa, and expanding internationally in Australia, in Indonesia, Canada, and America, is doing significantly better. There'll be a counterbalance effect. Fertilizer may come down, explosives will go up, which means the net for Omnia may actually not be as bad as the market thinks. And if that's the case, the current weak share price should start to rally as the market suddenly puts 2 and 2 together and saying, you know what? Fertilizer may be down, but explosives may be doing much better than we anticipate. And because of farmers planting earlier and the slightly bigger crop in commercial maize, they may be buying more volumes. So more volumes may offset some price decline. But be under no doubt, agricultural profits will be down this year. I do not think it's going to be an all fall down situation. The other thing that's very interesting is that a major investment bank every year holds a huge investment conference in Cape Town. It's called an off-piste event. It's happening in the middle of next week at the Vineyard Hotel. I'm not invited because I kick their ass every year in the Financial Mail ratings, and they never invite me because why should they invite their competitor? But I tend to see most of the companies for cups of coffee anyway on the sidelines because of the relationships that I have. Omnia is one of the companies presenting next Wednesday. The information I've just regaled to you right now, I gained today at the NAMPO Agricultural Trade Fair that I participated in. So the institutional investors are going to be hearing next Wednesday what I've just told you right now. And if a narrative that I've just told you comes across as positively next Wednesday as hopefully it has right now, I don't think Omnia is going to be 54 Rand by the end of next week. So for me, it's a slight risky play, but I think at 54 Rand, with a 1 billion Rand share buyback also underway at Omnia, and the company is still looking to pay good dividends, it is debt-free, generating significant cash flow, and its working capital is extremely well managed. Omnia, to me, is one of those little gems which has been punished by the market this year, and I think unduly. And I think if better optics start to be regaled to the market at the event in Cape Town next week, and Omnia is a September interim results period, which means results will be coming out sometime in mid to late November, we could see a spark of life or a little bang in Omnia, to use the explosive term, in the next couple of months. So Omnia, for me, is a very interesting play. Another little sippy. I'm then going to come on to a stock which I think possibly has one of the best earnings curves in the mid-cap space in the next 2 to 2.5 years. Its share price year to date is up 3.3%, but it has come down from a high of 70 Rand. The current price is 52 Rand 50. So it's quite weak compared to its near-term high. That stock is mid-cap mining and resources company Afrimat. For those of you that have listened to me on this platform and who read my research, I've been positive on Afrimat for quite a number of years. I first picked up coverage at 3 Rand and 15 cents, and Afrimat, on a 10-year view, has been the single best performing stock on the JSE. Everybody thought it was Nationale Pers or Naspers. It wasn't. It was Afrimat. Afrimat at one point in time was up in the last 10 years 1,800%, when Naspers was only up 1,400%. So you would have made much more money holding mid-cap miner Afrimat than you ever would from buying Naspers. So why has it fallen back? It's fallen back for a combination of reasons, which I will elaborate to you right now, which I think is a fantastic opportunity to pick up possibly one of the best managed mid-cap stocks that I cover, and possibly the best capital allocators in the mid-cap sector that I and many of my institutional clients actually cover. Afrimat is involved in varying buckets. Its largest bucket is in iron ore. It's also involved in anthracite. It also has industrial minerals, products used in the making of glass, lime that goes onto the land, and other products. It has construction materials that go into ready-mix cement, aggregates in roads, etc., etc. In the last 12 to 18 months, we all know that this economy has not grown. The ANC government has got bugger all money to spend on anything, and as such, the underlying infrastructure market has been quite poor. And as such, the construction market has been quite lackluster, which means the construction and construction materials profits from the entire sector has been quite weak. Load shedding has also had a huge impact on the industrial minerals market, which needs energy to produce the products that are basically sold. The biggest part of Afrimat's product mix is iron ore. And in the last couple of years, having reached a peak of $220 a ton, iron ore bottomed about a year ago at $90. As I sit here today, it's trading at about $116 round numbers. But in the same period, the Rand against the dollar has depreciated marketably, which means the Rand price per ton that the likes of Afrimat and Kumba are making is still quite juicy, particularly if you know, as I do, that their underlying cost of production are roughly 1,000 Rand a ton. So if you're selling your iron ore at roughly 2,200 Rand a ton, and it's costing you 1,000 to dig it out of the ground, you're still making a very, very healthy margin. Also, they've expanded their underlying production at their varying iron ore operations called Demeneng, Driehoedspan, and Jenkins. Jenkins supplies ArcelorMittal internally, and Driehoedspan and Demeneng are for the export market, which is doing quite well, thank you very much. The real kicker to Afrimat is going to come from the following two areas of growth. One is called Unkamati Coal. They bought from Union Mining many years ago an anthracite mine which had been bedeviled by poor operational performance, flooding, cave-ins, and all sorts of calamities. Afrimat bought it. They sold off the rubbish assets that they didn't want, and they ended up getting the Unkamati mine basically for free. They've spent roughly 400 million rand of capex in improving that mine, new capital equipment, upgrading the wash plant, new transfer facilities, new conveyor belts, and going underground. They have intent to increase the production of that mine to between 540,000 and 600,000 tons a year. Now, to give you context, year to date, that company produced 360,000 tons, round numbers. So in the next 12 months, you could see a near doubling of the capacity coming out of the anthracite mine. Now, that leads to all sorts of operational efficiencies. So if you put the cost base in to make very good money from the current 362,000 tons, imagine how much money you're going to make if you're producing 600,000 tons a year, where your average operating margin per ton is roughly 800 Rand a ton. So those of you who can do simple mathematics, 600,000 tons times 800 gives you just shy of 480 million Rand a year in potential profit from a company that lost over 100 million Rand a couple of years ago when it was bought out of administration and was being rehabilitated and restructured. That's one hell of a turnaround that'll feed through into the underlying earnings of Afrimat in 2024 and 2025. The market is beginning to cotton onto that little fact. Only a handful of us actually visited the Unkamati site visit in January this year. I went and I was amazed at what I saw, as were the clients that accompanied the event with me. The other key growth inside Afrimat is a few months ago, they bought for 54 or 58 million US dollars, roughly R1 billion round numbers, the Lafarge aggregates and cement business in this country. Now, Lafarge is actually owned by the giant Swiss company Holcim, who just basically said, that's it. We've had enough of operating in this country. The government isn't spending on infrastructure. There's load shedding. There's all sorts of problems. We just want to get the hell out of this country. Interestingly, a few weeks after that, Intercement, which is also a very large player in this country, they own Natal Portland Cement, NPC. That's owned by a Brazilian company. They also said, that's it. We're also leaving. And in Lafarge's case, Afrimat bought a business at a very, very good price, buying an installed capacity of 1.8 million tons for, roughly R1 billion. Whereas a few weeks later, the Chinese company Xiao came in and they bought Intercement, which is basically Natal Portland Cement in Natal and a very large cement business in Mozambique. And they paid $265 million, which roughly equates to about 5 billion Rand for installed capacity of about 3.5 million tons. Now, granted, they have virtual exclusivity in Natal, given the coastal operation, and they also have a very large market share in Mozambique. But given the price that Afrimat paid for its installed capacity, compared to what the Chinese paid, I went on public record saying that Afrimat did the deal of the century. The French wanted to leave, and Afrimat was there to pick up the pieces. Now, not a great deal of information was disclosed about Lafarge, but as I've written in my notes, and the benefits of attending, again, annual general meetings, as I did in early August, is that Lafarge has an annual revenue of 3.5 billion Rand. In 2021, round numbers, they made a profit of 330 million Rand in 2021. In 2022, because of a weak economy, load shedding, and the lack of infrastructure works, but profits collapsed to roughly 38 million Rand. So on a purely price earnings basis, Afrimat may not have done a sweet deal, but on the assets that they bought, which are some of the best aggregates and quarries in the country, they have got the cement assets basically for free. So if I manage to turn this company around and to get back to a normalized earnings number for Lafarge, which I estimated around 300 million Rand, you can quickly see there could be a tenfold increase in the profitability coming from Lafarge in the next 2 or 3 years if Afrimat managed to turn that company around. Now, have I done it before? The answer is yes. Every single deal but Afrimat has acquired from Glenn Douglas, the 35 million rand nearly a decade ago, to the other large transactions from Cape Line, Clinker, Infrasource, Demeneng, Unkamati. They've turned a substantial profit. I believe that the Afrimat magic of turning around unprofitable, badly run operations to become huge businesses is there for Lafarge. And I'll give you one example. About 7 years ago, they bought out of administration an iron ore mine called Dero, which they then renamed Demeneng. They paid roughly, round numbers, 300 million rand for that business. And they then had to spend 400 million rand on capex to rehabilitate the mine and put in much better technology to actually cope with taking the production to roughly 900,000 tons a year to the export market. At its peak last year, that iron ore operation made R1 billion in profit in 1 year, showing that the underlying cost of the business and the capex was repaid in 1 year. I believe that Unkamati's capex will be repaid in the next 12 months, and the Lafarge capex of roughly 300 million rand will be repaid in the next 12 to 18 months. So alongside the ongoing profitability from iron ore, we got a huge swing coming from anthracite in Unkamati coal, a potential recovery turnaround in Lafarge, and then the ongoing recovery in industrial minerals, which is actually quite small in the mix. So the peak earnings for Afrimat last year were R5.42. They did see earnings fall this year, down about 15%. I'm forecasting that earnings next year will bounce quite sharply, with 2024 and 2025 being recovery years for Afrimat. I can quite justifiably publish a note right now, suggesting to my institutional clients that Afrimat has a potential in 2026 to have earnings of 10 rand a share. Now, on a share price of 52.50 rand, if they do 10 rand in 2026, which is only a good 2 and a bit years away, because the market always looks forward, I think that Afrimat at 52.50 rand is one of the most compelling buys in the mid-cap universe for those with patience and who understand that the management team of this company is possibly one of the best in the mid-cap universe. Another sippy, and I'm going to do a quick rundown of a couple of stocks that I know that the audience will want some information on. When my last sip is gone, I'm going to Q&A. I've nearly been here for an hour. Renogen, a stock that I know that many of you out there will be wanting to know what's Anthony Clark's view. Year to date, the stock is down 22.3%, and it closed business today at 18.95 rand. Now, we all know that the company has been beset by a number of problems, and as the de-risking of institutional portfolios has occurred, the stock has not been flavor of the month. And as I've written in a number of columns, including last month's headline feature and cover story in the Financial Mail, Renogen sadly overpromised and underdelivered, and that saw the share price materially derate from its one-time high of 43 rand. Have I given up on the company? Absolutely not. Every company goes through a period of transition, and I think they've learned from overpromising and underdelivering, which is why Renogen so far this year has been very quiet. All you've seen is regulatory filings and results coming out. They've not told you about any new fines. They've not told you about underlying production. They've not told you about any new customers. What they have told you on is the helium operation went off stream in June because of a technical issue from the Chinese engineers. As of the weekend, that problem has been fixed. The cold box, which was dismantled a few weeks ago, went to Secunda and has now been reinstalled back at the site in Virginia in the Free State. Commissioning is currently underway for an engineering handover, as Renogen promised, at some point in October, and they'll then start helium production once again. LNG production has gone on unabated. I spoke to Italtal last week on their results, and Renogen is supplying console glass and Italtal with LNG with no problems. In fact, there's more demand for LNG than it actually is current supply, because of the energy situation coming out of ESCOM. So some tidbits, as my FM article alluded to last month. And if anybody has not read that article, I would urge you to get a copy of the old Financial Mail. It's got a picture of a guy on the page holding a helium balloon saying, will the share price fly? And I think its time is coming. The last quarter of this year is probably going to be the most important 3 months in Renergen's entire listed career. Why do I say that? As it stands right now, the second SEC filing for the listing of a stock on the NASDAQ is currently underway. The roadshow will then start to raise $150 million in the United States. We already have the granting of $750 million of funding from the Development and Finance Corporation, which is an arm of the US government, at sweetheart low interest rates. And then Standard Bank chipped in another $250 million. So as it stands right now, as I quickly work it out, they have got funding of $14.25 billion in the bag, which is a long way towards a $21 billion cost of Virginia Phase 2, which should enter commissioning in 2027 and full production in 2028. So the NASDAQ money isn't actually really needed right now because they have enough debt financing to actually start the project and the underlying construction and the EPC, as it's called. But the NASDAQ money will be nice to have. It'll also raise the company's profile. Now, if any of you out there that have followed my commentary on Montauk, which is an alternative energy market which is listed on the JSC and in the US, there's been a fundamental rise in the valuation of renewable energy companies in the United States since the end of June, because the Environmental Protection Agency, the EPA, changed the level of standards and pricing for renewable energy companies, making them far more attractive investments because of the level of subsidies and kickbacks they got from the government and industry for operating in a green renewable energy space. Montauk, as an example, since I wrote about the stock at the end of May at 125 Rand, is up nearly 50% in the last 3 months to approximately 190 Rand. The entire investment landscape in the US has fundamentally re-rated because of the changes in the legislation implemented by the green-friendly, bunny-hugging Biden administration. Renergen is now listing in a US market where the Dow remains elevated, where the NASDAQ continues to be powered by the major technical stocks, and the underlying environment for renewable energy companies, given the EPA changes, has fundamentally changed for the better. And it'll be listing at one of the lowest EV/EBITDA multiples of any company listed currently on NASDAQ. So they believe that the listing will draw significant interest from US-only institutions. Be under no doubt there will be no capacity for domestics of African institutions to participate in the US listing. So anybody thinking of shorting the stock here to buy it back in the States will be sadly mistaken. They're still on record as believing they can place the stock at significantly high levels of the current 18 Rand 95 currently trading on the JSE. But there's one last piece to the puzzle, and I'm going to keep you in suspense for 1 second. The last part of this puzzle is early last year, many of you may recall that they agreed to sell a 10% stake in their LNG and renewable gas division called Tetra 4 to the Central Energy Fund for 1 billion Rand, which valued the entire business of Renergen at 10 billion compared to its current round number market value of 3 billion. That deal was never consummated. The CEF has got no money. Ever since they sold our strategic oil stockpile for less than nothing, they're basically bankrupt and have got no money. But that stake was still in discussion, and other parties potentially have entered the fray. And as I alluded in my Financial Mail article last month, which again I urge you to read, and if you haven't, it is on my Twitter page at SmallTalkDaily. I actually posted the entire 3-page article there last week. I speculated that a very well-heeled Black Empowerment Fund is potentially going to be buying that stake at exactly the same valuation, 10% for 1 billion rand. If that deal is inked and that announcement ever does come, and as I said, I'm just speculating here that a deal perhaps is mulling in the wings. Nothing is confidential here. All I'm hearing is whispers and rumors in the trade. If that does come out in the coming weeks and months ahead of a NASDAQ listing, it'll go a long way in improving the underlying valuation proposition in Renergen ahead of a NASDAQ listing. So as I'm saying, bear in mind, keep an eye, one, out for that 10% stake sale, and secondly, keep an eye out on the US roadshow and the eventual listing. I think the listing will probably happen towards the end of this year, and the book building and the roadshow will get underway at least in the next month to 6 weeks, which is why I've said at the start of this little preamble on Renergen, I think we are in for the most exhilarating 3 months of a company's life. Barring an unforeseen calamity, like a global stock market crash, some form of major international conflict, or a collapse in financial markets, Renergen could be going into a very interesting listing scenario in the United States. So that's enough about Renergen. I'm giving no recommendation. I'm just saying that the prospects of a company look interesting, but a number of hurdles need to be jumped. And I think these could be jumped in the weeks and months ahead. And lastly, a very quick comment on a stock that I know that many in the market have been commenting on, which is Nampak. It's currently down 15.6% year to date, trading at 221 Rand 35 cents. If I work that out in the old money, given it was had a 251 consolidation, that in old money is about 89 cents a share. Now, the low in this stock was roughly 64 cents. They currently have a rights issue underway, which is 2.2 new shares for every one share held at 175 Rand. And as you saw last week, despite the headlines in the business day, when the journalist said the share price had crashed, the journalist clearly does not understand the ex-rights price of when a company actually adjusts to the additional shares in issue of a lower value. So it's currently trading exactly what I thought it would be trading, roughly 230 Rand a share. The rights issue, as you know, is still underway. And you saw that Coronation has agreed to underwrite a 300 million Rand. One of the activist shareholders, A2 Investment Partners, has gone in for 100 million Rand. And there's been significant interest from many of the major institutions in this country, like Alan Gray, PSG, amongst others, in participating in the rights issue. So I've gone on public record stating that the rights issue, as far as I've seen it, will be a 100% success. It'll be heavily oversubscribed, and any doubts that the market has that this issue will not succeed are unfounded. Phil Roux, the new CEO, has gone in at a lightning pace, and I nicknamed that gentleman I've known for the best part of 20 years, Phil the Knife, for a reason, because he goes in and he loves cutting costs, cutting people, selling assets, trimming excess fat, and taking a company back from a brink of disaster, becoming a profitable enterprise. And as we've seen in recent updates in Nampak, he has certainly lived up to his name as Phil the Knife. And I think post the rights issue, you are going to get an operational update, particularly towards the end of the year, indicating that assets are being sold. They have sold the non-beverage assets in Nigeria recently for 180 million Rand, and there are assets on the table to be sold for a minimum of 2.6 billion Rand, with significant costs also coming out of the business, with no salary increases, significant retrenchments, sale of superfluous properties internationally, and the closure of certain assets, which, again, do not contribute to the overall well-being of the economy, of a company. So I'm very confident that Nampak, which I chose this year as my wild card, will actually perform quite well. And right now, it's actually in the profit for me, just even given me following my rights in my technical portfolio, is up roughly 10% year to date. So if I was a Nampak shareholder, which I am personally, I would be following my rights and sitting back and watching the ride. It certainly will not be an unbumpy ride. There are hurdles to be undertaken, but I think that the current management put in place by the activists and the strong support of institutional shareholders would clearly be brought to bear. And I sit here right now, having published this, and I have a private bet with a number of institutions stating that within 2 years, Nampak will be 500 Rand a share, which is double the current share price. I may be right, I may be wrong, but I'm known for my bold targets. They often get attained. So we will see in 2 years if my Nampak share price has actually got to my level. On that note, I'm taking my last sip, and I'm going to have a quick look at the Q&A. Now, I have very poor eyesight, so if I lean into the screen, it's because I'm having a read of what's going on. Let me have a quick look. First question here from Louis. Do you ever sell a stock when it hits your price? The answer is no. If it hits my target price, I often readjust the target price upwards if the underlying fundamentals of a stock remain sound. And as I mentioned earlier, when I chose CANS at 5.34 Rand, I set an 8.50 Rand target price. It made 8.50 Rand a few weeks ago, but the underlying prospects of the company have actually improved in the year that I actually made the recommendation, which is why I've improved the target price to 11.50 Rand. So in many cases, as target prices are made, if the underlying fundamentals in that company are unchanged or have improved, then yes, I will reinitiate a higher targets. If the underlying prospects of the company have actually diminished, then I will happily sell and recycle the money into a better prospect. I'm hoping that answers your question. Let me look. Let me scroll down. CAA, we've talked about that. We've talked about that. We've talked about that. I don't cover Brickcore. I've discussed Omnia. We've discussed Omnia again. A quick question on the Omnia SARS issue. I asked the management today, has there been any progress in the SARS issue? They said it has moved forward a few steps, but there's still no resolution. They're still hoping to get some form of resolution before the end of their financial year, which is March next year, but nothing to date. Price target for Omnia, on public record, 85 Rand. Nampak, we've just discussed that. Omnia target price, we've just discussed that. Looking down, Montauk, I've discussed quickly Montauk. I don't cover Brickcore. Any good news for Zeda? No, it's an old donkey. I've written extensively on Zeda in the last couple of months, following a recent AGM that I participated in. Basically, there are two assets left inside Zeda, which is ZARD, the international seeds and agricultural requisites business, and then there's Capespan, the domestic fruit grower and international wholesaler. Despite the fact that the company is sitting on a near 40% discount to its net asset value, and it recently got a 5-cent special dividend from the proceeds coming in from Agrivision, the African sale, there are more special dividends coming of just under 20 cents a share from the residual proceeds coming in from the sale of the logistics company. But until the large assets of ZARD and Capespan are sold, which I think will be very, very difficult in the current economic environment. One, because ZARD is stuffed full of debt of over 800 million Rand, which means it's a much harder sell to sell a company stuffed full of debt. And Capespan, because of its very size of about 1 billion Rand, there aren't many people in this country who have the expertise to take on the emotive issue of buying underlying operating assets and farms in this country, which need the BEE requirement, not just for the land, but also now water rights. So sadly, Capespan is hamstrung by its very size. having an international operation in wholesale, which had a bit of a dent last year because of the Russian situation, because a fair proportion of much of its products went into the Russian territories market, which has now been precluded. And the fact that its domestic operation has the emotive issue of land and water rights. So I don't see anything happening inside Zeda for quite some time. So I wrote about a month ago, but holding Zeda is like holding dead money. And I said, unless you truly want to hang on to get the 20-cent special dividends, which will come through next year, then I do not want to own any dead money, and I would sell the stock. I'm quickly flicking through any questions that have come through laterally. There's a question on SabCap. SabCap today hit a 52-week low of 68 Rand. It is down 18% year to date. I'm a SabCap shareholder. I have absolutely no intention of selling this stock. I had breakfast with Christopher Seabrook, who actually runs the company. And for those of you that don't know, SabCap is basically a private family wealth office, which basically manages his family money. So when you're investing in SabCap, you're basically investing alongside a billionaire financier with a near 30-year track record of running and managing private equity assets. He has a fantastic long-term track record, and I want to be invested alongside a seasoned professional investor. Why has the stock been weak? The answer is very simple. Inside the portfolio is a tiny holding in overall valuation terms called transaction capital. Any of you that have been following the market knows that transaction capital, which is trading at 40 Rand a share about a year ago, is now trading at about 6 Rand a share. SabCap at one point had 10 million shares, worth a great deal of money. They sold 5 million shares last year in the high 30s, and they recycled that money into new investments in ARB Holdings in electrical cables, in Hailwood International in liquor, and they bought a pet business called Velmont. So they made significant new investments, which have performed extremely well. They then kept 5 million shares in transaction capital, which at one point last year was worth 165 million Rand. But then the share price, as we all know, at the end of March this year, fell in an almighty heap because of problems inside SA Taxi. To add fuel to the fire, SabCap thought that transaction capital looked cheap, and they bought 1 million more shares to take their holding to 6 million shares, which are also now losing money. So you now own 6 million shares in transaction capital, in round numbers worth 30 million Rand, which in the overall scheme of a portfolio worth 5.275 billion Rand is only 0.05% of a portfolio. So the market has completely smashed the share price of SabCap for an investment now only worth 30 million. So I told Chris Seabrook last week, if you were to sell that piece of shit, excuse my colorful language, I think your share price would rally, because the market is giving you a negative issue because of your participation in transaction capital. In the next 6 months, a couple of his very large investments should have re-ratings, SA Bias, ITL, amongst others. I'm still looking for net asset growth in this company, which is roughly in round numbers 114 Rand, to move up to the end of December. And as it stands right now, as I do a quick back of a matchbox calculation, the discount to net asset value inside SabCap is 40%. Now, if I can buy a basket of quality unlisted investments from a seasoned entrepreneur, which has a long-term capital growth of north of 16% per annum at a 40% discount, because the market is currently pissed off because he has one tiny investment which is not doing that well. But you know what? I'm happy to buy this company, sit back and wait. To any portfolio looking to generate significant capital returns over the longer term, I would recommend owning SabCap, closing your eyes and saying in 5 or 10 years, saying, thanks, Anthony. You're currently going through a short-term lull. There's been a bit of a seller in the marketplace because one specific individual is realigning his portfolio for personal family reasons. He's in ill health, and he's currently selling some stock in the market, but it's actually very small, less than 300,000 shares. That stock should be digested in the near term. So I would certainly not be bailing out in SAPCAP at 68 Rand, purely because the market is a little bit jaundiced. In fact, at 68 Rand on any weakness, I would happily be buying into the stock and sitting back and waiting for growth to return. I'm a SAPCAP shareholder. I've been there for a number of years. I've known Christopher Seabrook personally for 26 years, and I'm not throwing him a towel because he made a bum rap on transaction capital. And quite frankly, every major institution in this country also got caught with their pants down when SA Taxi fell off the cliff in March this year. So let me quickly fall through the lists to see if anything new has popped up. And I'll take one last question before Pascal basically cuts me off. We've just talked about transaction capital. We've just talked about that. I don't cover Foresight. I'm just done Zeta again. One last question. Bear with me. Question here from Eugene. Given 2 years falling profits and now dividends, how is management so positive? Bowler Metcalfe is also optically the most expensive packaging company on both a PE and dividend yield basis versus the relative sector. BCF's outlook statement seems very muted to me in the last financial results. You are absolutely correct. The market value of the stock, it's trading at roughly 8.77 Rand. But Bowler Metcalfe is debt-free, has net cash of round numbers 3 Rand a share, and property of around 2 Rand a share. So the core packaging division, if you strip out cash and property, which you actually shouldn't, is probably trading on a PE of about 3 or 4 times. Friedel Sass, the CEO and the son of the founding shareholder, the family remains substantial shareholders, was very optimistic in the results presentation that actually was undertaken in Cape Town last Friday. For anybody that's not looked at the Bowler Metcalfe results, I would absolutely urge you to go into the Bowler Metcalfe website and download the investor presentation that they did to institutions and sell-side analysts last Friday, and look at the annual financial report, which also came out last Friday. Friedel Sass told the accumulated audience, and I know that because I'm looking here at my little black book. And my little black book, which takes significant notes. I took 11 pages last week of notes on Bowler Metcalfe. Now, the stock is not for everybody. At 8.77 Rand, it is illiquid. It's had a terrible first half of last year. Its second half is significantly better. They have gained 500 million Rand of new contracts for one simple reason. You are well aware of the global supply chain issue that many companies have in sourcing products from varying parts of the world, getting them across the water, landing at our inefficient ports, and then getting them to marketplace. Many large international consumer good companies have now realized if their products are not on the shelf, the consumer will not buy them, or they'll buy a competitor's product. They are now beginning to partner with Bowler Metcalfe to indigenize the domestic production of key packaging requirements, because they've realized that by actually paying a little bit more for reliable supply and quick access to market is a price worth paying to keep your product on the shelf. Because if your product is on the shelf, it means that you're not buying a competitor's body lotion, shampoo, bubble bath, etc., and that's exactly what Friedel Sass told us last Friday, is they're winning significant new orders from indigenization of product. They've also installed significant capacity regarding load shedding in energy requirements, and they've also re-optimized their business to actually not be as badly hit when load shedding actually occurs. Now, they are experts in the field of plastic packaging, particularly for complex packaging that we all seem to buy. Those very interesting catches on shampoo, body lotion, personal care products, etc., etc. And they do that with expertise that are virtually unrivaled with other players, and all the color printing that goes as well. Now, I would certainly not advocate running out to buy Bowler Metcalfe as an average, ordinary investor. But saying that, as I look at my page here, bear with me 1 second again, my Anthony Clark column in this month's Financial Mail talks about Bowler Metcalfe and why I think for a certain type of investor with a certain type of risk profile, with a certain type of interest in investing alongside owner managers, and we have some significant institutional money in the stock, some smart money. Bowler Metcalfe, at the current share price, it was at 8 Rand when I saw them last Friday. It bounced to 9 Rand, and we're now at 8.77. On a weekday, if I could pick up this stock at 8 Rand or less and sit back and wait a couple of years, I've got a target price of at least 10 Rand 50, if not 11 Rand. And I would also say that the interest in this company, not just from institutional markets, but also from potential acquirers of the company as the family transitions away from running the company to just being passive shareholders, potentially as well, may lead to corporate activity at some point in the future. Now, I've gone way past my time. It is coming up to 8 o'clock. Pascal will probably start throwing bricks at the screen. I do hope that the participants of this Rand Swiss webinar at least got some highlights from the stocks that I ran through, which were Omnia, Afrimat, Coro, Sabcap, Stadio, CANS, Nampak, Renogen, Bowler Metcalfe, amongst others. And hopefully that this webinar will give you a little bit more color and some insights as to what I see as a working analyst kicking the tires, going out every single day to try and find information which is not commonly available to the average institutional or private client market. So on that note, my sincere appreciation to all of you that have taken time out of your Wednesday to listen to this. There will be a recording of this entire transcript on YouTube. So keep an eye out on the Rand Swiss webpage and the Rand Swiss Twitter page. And if you want to follow me on @SmallTalkDaily, many of these comments and this recording will again be on stream in the coming days. From me from Cape Town, have a wonderful evening and see you in the next quarter. Take care.